Todd Uzel here, mortgage loan officer. I know that sometimes when you're buying a house or thinking about buying a house, it can be confusing. It can be a bit of an information overload, and some of that is from trying to figure out which loan type is going to fit for the purchase you're trying to make. And the truth is, you don't have to know, but you should know what the differences are. So when you talk to a loan officer or talk to your realtor, you'll be a little more educated. So we're going to run through the four main types of loans that you could get for your house depending on where you live and whatnot, and hopefully clear up some of those questions. So number one, we're going to talk about FHA loans. FHA loans are generally designed for a primary residence, often used by first-time home buyers because down payment is a little bit lower, competitive interest rates. So overall, it's a nice loan. In Arizona, you have every loan has loan limits, like a max that you could buy with that loan type. And in Arizona, those limits vary from like 560 to down to 520. And the reason there's a difference is because in Coconino County, which is where Flagstaff is, it's more expensive. So the FHA loan limits are a little higher. If you went to like California, I think there's FHA loan limits close to $1 million or like 800,000. So they try to work with the different values in different areas. Like Maricopa County, the FHA loan limit is $546,250. When you say loan limit, that means what your loan is, not what the sales price is. So in this case, if you're bringing minimum down, which for FHA is 3.5%, you're probably looking at somewhere in the 560 to 570 purchase price range. And that once you put your down payment, then you'd be in that 546 max loan amount. So that's what you use FHA loans for. Most loans as well have DTI maxes, or the max debt to income ratio you can use for that loan type. Standard thing everybody knows is 43%, meaning that we take your gross monthly income and we can use 43% of that for whatever debts you have right now, like credit card, car payments, things on your credit report, and the new house payment. So that's your standard, but the truth is we can go up to about 56.5% for an FHA loan. That's the max I've ever seen get qualified. So not widely advertised, but FHA loans will allow you to stretch your debt to income ratio a little more. So something to think about, and just easy math way to think about it is, say you made $10,000 a month. On the standard size, we could use $4,300 for the new house and everything else. So if you're buying a $500,000 house, right now a $500,000 house in Arizona, minimum down payment is probably going to run you $3,700 a month. So if your house payment's $3,700 a month, then your max DTI is only going to take you to $4,300. It doesn't leave a lot for car payments and student loans. So you can see where that 56% debt to income ratio might be a better fit, or at least allow you to stretch your debts and increase your purchasing power. Minimum credit score on FHA it's actually 500, but reasonably 580. So if you had a 500 to a 580 and probably a reasonable debt to income ratio, you could come in with 10% and use an FHA loan. For everybody else, 580 and above, minimum 3% down. Let me scroll down here. Yeah, minimum 3.5% down, and that's it. Very low barrier to entry. There are down payment assistance loans that use an FHA loan option, so the down payment assistance will cover your down payment instead of you bringing the 3.5% in. And down payment assistance loans have their own set of rules. Lower DTIs generally, they do have an income cap, and those are the big ones. Typically a higher required credit score as well. So that's for down payment assistance. We'll discuss that in another segment. But other pieces to FHA loans that I wouldn't call them drawbacks, drawbacks, but I would call them things to know. FHA loans have upfront mortgage insurance, which is 1.75% of the sales price. So, I'm sorry, 1.75% of the loan amount. So, the way to think about that, $500,000 loan, you're looking at 5, 7, about 9, 10 grand that's going to be added on to your loan. Now that doesn't count towards your max loan amount. So if you're on the edge there at that 540, the upfront mortgage insurance is added on, would still be added on, just wouldn't count against you from a loan max perspective. So that's one downside. And from a payment perspective, if you added $10,000 to your loan, that's probably going to add about $75 a month, give or take. So that's another reason why I think FHA allows for a little higher debt to income ratio, because they're hitting you with that upfront mortgage insurance. All FHA loans also have monthly mortgage insurance, which is, for all intents and purposes, the percentage ratio is 0.55 annually. So, there's a math problem for that, but pretty simple. Those are the two big ones, things that would keep you from getting an FHA loan. If you had a bankruptcy, Chapter 11, Chapter 13, generally there's a 2-year seasoning for an FHA loan. So from the date of discharge, you would have to wait 2 years until you could close on an FHA loan. Other than that, an FHA loan is considered a government loan. So if you have government debts, like if your student loans are in default, like you couldn't get an FHA loan for that. You have to get them out of default or do the repayment program or something. If you took an SBA loan or a PPP loan during COVID, that could be a disqualifier for you if that wasn't paid back or forgiven. So there's a few things that'll keep you from getting an FHA loan. For the most part, it's very buyer friendly. Like I said, low barrier to entry, and overall it's not a bad loan. So something to think about. We're going to move on to the next loan type, and it's going to be conventional loans. You might have heard of Fannie Mae or Freddie Mac. Those are the two companies that kind of insure or run the conventional loans. They're both pretty similar, a couple of differences, but for the most part, whether you run a Fannie Mae or Freddie Mac, they're both conventional loans. There are times where you might qualify for one and not for the other, but that's kind of inside baseball loan officer stuff, so not to be worried about. Loan limits for 2025 on conventional loans in Arizona, max loan limit is $806,500. So $806,500. If you went over that, you'd be looking at a jumbo loan, and those are any loan that exceeds that essentially is a jumbo loan, and those have different rules. Normally 5 to 10% down, and other stuff that if you can afford a house like that, then you could have to worry about. But so conventional loans, $806,000 and change. Anything below that, you can get a conventional loan. Minimum down payment on conventional loans is 3%. Generally, when you're talking conventional loans, you're looking at different variables. So you're going to go 3%, 5%, 10%, 15, and 20. And if you put down 20, then you wouldn't have a mortgage insurance payment monthly. Unlike the FHA loan, there is no upfront mortgage insurance for conventional loans, which is nice. The difference in your when you have a different down payment amount, that's going to vary your mortgage insurance amount. So 3% would have the highest mortgage insurance, 5 would be less, 10 would be less, 15 would be less. And if you have excellent credit, something in like that 720 plus range, your mortgage insurance is going to be kind of minimal. So a lot of people are like, well, I want to put 20% down. I really want to avoid that mortgage insurance, and that's okay. But if you look at the difference between putting 20% down on a $500,000 house, that'd be 100 grand, and maybe putting 10% down and paying mortgage insurance for the first few years until you refinance or until your home appreciates to that 20% level, then you really have to decide what makes the most sense. So you could put 100 grand down at 20%, or you could put 50 grand down and pay, say, $125 a month in mortgage insurance. So just have to decide where that 50 grand is going to serve you best. And most of my financial advisors that I work with will say we can beat the housing market with that 50 grand versus than putting all of it down on a house. Because once it's in your house, if you need it for some reason, you can get it out, but then you got to pay to get it out. So those are just things to think about. Those are strategies we talk about as we go through the loan process with our clients. Minimum credit score, let's see. Truthfully, it's probably 680, but on the books, it's 640. So technically, you could get a conventional loan at 640. There's reasons you wouldn't want to, and the biggest reasons are mortgage insurance, because that mortgage insurance, one of the biggest determinants is credit score. So if you're sitting on a 640, you might be better off getting an FHA loan versus getting a conventional loan and taking a like 1.5% mortgage insurance or something crazy. Because keep in mind, you can always refinance when the market allows for it. Right now we're in a kind of a 7% market, and as rates move, and a lot of people think they'll move down at some point. So say they move down in the next year or year and a half, well, that's a refinance opportunity. And refinances are pretty cheap. At the very least, you're going to pay title fees, and if you do some sort of a rate buy down, you can roll that into your loan. And that's what people really like about refinances, is you don't necessarily have to have an out-of-pocket cost. Maybe you pay for the appraisal if you're doing a cash out or something. But yeah, for the most part, refinances will allow you to just roll whatever costs you had into the loan, and it's a very inexpensive experience to reduce your rate, reduce your payment, whatever reason you're doing for refinancing. But so those are things to think about when you're putting your down payment, or kind of how the loan structures is, what are you going to do over the next 3 to 5 years? Are you going to stay in the house? Would you like to refinance if possible? There's always things to talk about, and that's why most of the time the relationship with the loan officer is a long-term conversation, because owning a home is a long-term conversation, and your needs change over time. So ideally, you're 680 or better for your credit score. Like I said, minimum down payment is 3%. PMI, or private mortgage insurance, is paid on any loan to value over 80. So if you put 20% down, your loan to value is 80%. Anything over that, you're going to pay some mortgage insurance. And like I said, your excellent credit generally means a very competitive low mortgage insurance rate. Let's see what else we have here. Biggest downsides to conventional loans are they're just more restrictive. It's harder to qualify for them. Max debt to income ratio is 50. And when we talked about max debt to income ratio, that's all of your debts, including your new house. There's also what's called a housing ratio, which means the ratio of the house payment to your monthly gross income. Generally, the max on that is going to be 45. So if you have zero debts, you make 10 grand a month, and you're wanting to buy an $800,000 house, you might not be able to qualify because your payment might be more than 45% of your monthly income. And so, we try to work with that. If the payment in this case, you made 10 grand a month and your payment was $4,500, that would be tight, right? If it was $4,800, probably couldn't do it. We'd have to figure out a way to lower that payment or find a different property. But housing ratio is just the new house payment as it relates to your income. Debt to income ratio is the new house payment and all your other debts that are on your credit report. So those are just things to think about as you're, mentally putting your loan together or jotting things down. That 45 to 50% is pretty standard across most loan products. And, as loan officers, if there's a way to stretch, we will. We'll always try to get you what you want. But that 50% ratio is always a good place to start from a consumer's perspective when you're just kind of penciling the math in. So that's conventional loans. They're great. Eventually, almost everyone will get into a conventional loan because they do want to avoid that mortgage insurance over time. In the short term, it's not that punitive, but if you paid mortgage insurance for 10 years or, the life of the loan, there's probably a better place to put that money. So conventional loans, as long as we can get your credit where it needs to be, that's probably where you're going to end up once you're a homeowner. So, all right, next up on the loan list is USDA Loans. Now, USDA is the United States Department of Agriculture, and it's a really cool loan. I loosely say it's like a VA loan for non-veterans, and I say that because a 100% financing loan. There is no down payment required. They have what's called a guarantee fee up front, which is 1%. And similar to the FHA upfront mortgage insurance, but the USDA calls it a guarantee fee, and they also have a guarantee monthly fee, which is super low. It's about half of what the FHA fee would be on the mortgage insurance. But outside of that, USDA is a great loan. It only applies to what they call rural areas. And in Arizona, just for some examples, say the Phoenix area, you have to go south and east. You can go to Coolidge, Florence, Eloy, Arizona City. Casa Grande used to be a part of that. Now it isn't. Maricopa, I believe, used to be as well. There may be some pockets of Maricopa in the Southeast Valley that still will allow you to use a USDA loan. And I'll do a video that kind of walks through how to do eligibility for all that stuff. But there's a website where you plug in actual addresses, and it'll tell you if the address is eligible for a USDA loan. And if it is, then we kind of move on to the next thing. We look at credit. Ideally, you're 640 or better. 680 is even better, and the reason for that is the different increments will allow you to stretch the debt-to-income ratio a little bit further. In my experience, a 680 plus score will allow you to have a 46 debt-to-income ratio, 46% on a USDA loan. And I believe your housing has to be 38 maybe. But so it's a little tighter ratios. USDA does have an income limit, and that varies county to county. Somewhere between $7,500 and $1,000, depending on your household size. So USDA does say, how many people do you have in your household? Do you have 6? Well, if you have 6, you're going to get a higher max income than if you just have 1. But yeah, generally it's somewhere in that 75,000 to 100,000 range in Arizona. And let's see, like I said, it only applies to certain areas. But if you live outside of Pinal County or Pima County and Maricopa County in Arizona, it's likely you could use a USDA loan. There are some restrictions. Manufactured homes, they don't hate them, but they want them to be new. And I guess the rule is new and not new, or 12 months old and not lived in, something weird. But yeah, if you're going to do a manufactured home, you could use a USDA loan, but it must be new. Obviously, it has to be on a concrete slab, affixed, all the fun stuff that comes with owning a manufactured home. But you could use one for that. Rates are very competitive. Your comparable rates to a conventional loan or an FHA loan, your USDA is probably going to be about a half a point better. So like I said, if you are looking in an area where USDA loan for your primary residence, where USDA loan could be used, I definitely say to give it a try, because it's a great loan and it's just a great inexpensive way to get into a home. I really like them, and whenever I talk to someone that lives in those areas, I'm like, let's see if we can put you into a USDA loan. So just little goofy things that excite loan officers, but USDA loan is great, and if you're in an area that you could use it, I definitely recommend it. Okay, the next loan we're going to talk about is VA Loans, which stands for Veterans Affairs. I always thought it stood for Veterans Administration, but for the purposes of this, we'll say it stands for Veterans Affairs. VA loans are for obviously folks that have served in the military and gotten that benefit. I don't know what the criteria is from the military's perspective, but it seems like most folks that have served a couple of years or more get it. Again, I don't know if it works for reserves or folks that didn't serve active duty. But it's a great loan. It's a 100% financing, so you don't have to bring in a down payment. As always, if there are closing costs, we would ask the seller to pay for them. They're not required to, but it's always worth an ask. The cool thing about VA is there are no loan limits for your first VA loan. So if you can qualify for $1 million home and you want $1 million home as a veteran, by all means, it's a 0 down payment and it's pretty awesome. There's no mortgage insurance. So FHA has a mortgage insurance. USDA has a guarantee fee, and then conventional often has mortgage insurance as well. VA doesn't have that, so bonus. And there's no minimum credit score, but across the board it seems 620 or better is kind of where you want to be, and there's no minimum DTI either. So as your credit score improves or as your total financial profile is pretty solid, then you could stretch that debt to income ratio pretty high for a VA loan. I've seen into the 60s, so from that perspective, if you're making easy math, 10 grand a month, a VA loan, a veteran might be able to get a loan that would stretch him into a $6,600 total debt profile, say a $4,000 house payment and then a couple grand of other debts. So VA is a really cool loan. It's a great benefit for veterans, and the dirty little secret is you can own more than one house with your VA loan. The second one just has a little bit of math we have to do to make it work. So I love VA loans. Anytime I have a veteran, I'm always trying to figure out ways to use them, because it's just a really great program. There is a funding fee that comes with at the beginning. It's kind of like the upfront mortgage fee for FHA loans. But depending on your status when you were discharged, if you had any disability or anything like that, then that funding fee can be waived. And again, it just tacks onto the loan. You're not paying it out of pocket. It just adds to your loan. Those are some things to think about, and they do come up on VA refis as well. So as we go through the process, we kind of try to discuss all those things and try to be as transparent as possible. Just like any other loan, you're looking for a 2-year work history. Again, if you have some sort of a VA benefit that's coming every month for income, then we could use that as income. But everything else is pretty standard. Like I said, you're looking for reserves in the bank, 2 years of work history, then no minimum credit scores, but ideally it's around 620 or better. And again, the lower your debt to income ratio, that lower credit score might fit into the box. It really just depends on what kind of house you're trying to buy and what works for you and your family. A few high points to note: we've hit FHA, VA, conventional, and USDA today. And FHA, you can go really 580 minimum. I mean, there is a 500 product out there, but you got to have 10% down. Conventional, your guidelines 640, but realistically you're probably closer to 680. USDA, ideally better than 680. 640 will get you in, but your debt to income ratio is really a lot tighter with that. And then, like I said, with VA, 620 or better. And again, as your credit score and financial profile improves, then your ability to stretch that debt to income ratio is higher. As always, looking for questions. If you have them, drop them in the comments. I'll leave my contact information as well. I hope this kind of wrapped everything up in a pretty neat little bow for you, and we'll make some short videos, just so you can have bite sizes also. But once again, my name is Todd Uzel. I really appreciate you taking the time to watch this video. Please leave a like and a comment below, and we'll see you next time.